Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. We are launching into, well, a really crucial review today. We're focusing entirely on ASML's Q3 2025 performance and, maybe more importantly, their forward outlook.
That's right.
This company, it sits right at the heart of technological progress, doesn't it? Understanding where they're headed is pretty much a key to understanding the future of AI, advanced computing, maybe even geopolitical stuff.
Absolutely. And for you, the listener, this is really about more than just the financials today. The numbers were solid, sure, but they're kind of the foundation.
Right.
Our real mission, let's say, is to unpack this huge shift that's happening in their product mix, their strategy. It's all being driven by this massive tailwind from AI.
That AI factor again.
Yeah, and this critical pivot everyone's anticipating in 2026. We really need to dig into what happens when that deep UV business, especially out of China, starts to normalize, and the advanced EUV segment really takes the lead.
Okay, but before we dive deep into that strategic shift, let's maybe touch on something foundational first. Management stability. This isn't a business you change direction in overnight, right? It's built on long-term roadmaps, long-term relationships. And just last week, we saw this robust succession plan announced. It looks like it confirms remarkable continuity.
Continuity is absolutely paramount in this industry, right? We saw the reappointment of the executive vice president and CFO, Roger Dawson, and also Frederick Schneider-Monnery to the board.
Roger Dawson, yeah. He's been pretty visible.
Hugely visible and instrumental, frankly, in navigating ASML through, well, unprecedented supply chain chaos and these massive expansion phases. Securing his tenure, it really reinforces that long-term financial planning horizon. It sends a strong signal.
And, while continuity is great, they're also clearly investing in the tech future, too. They announced Marco Peters as the new Chief Technology Officer. He's not an outsider, is he?
No, not at all. He's a familiar face, spent over 25 years inside ASML. And that internal promotion is significant, I think. Peters takes the CTO role effective April 2026.
2026, so quite a ways off.
Exactly. This isn't some rushed hire. It's carefully planned leadership succession set almost 18 months in advance. It shows, I think, that ASML views its long-range tech planning, especially around high-NA EUV and, whatever comes after that, as their absolute core strategic competence.
Makes sense.
They need a seasoned veteran, someone who really understands the company's DNA to lead that effort.
So it kind of sets the stage perfectly, doesn't it? Confirms that the long-term vision they laid out last year is still fully backed by leadership, both incoming and current. Okay, let's get into the main discussion then, starting with the hard data from Q3 2025. Okay, let's unpack this Q3 scorecard. As expected, really, execution looked tight. Total net sales landed right at the midpoint of their guidance, $7.5 billion. Felt like a very managed quarter, showing that predictability they aim for.
Indeed, very controlled. And when we break down that $7.5 billion, system sales, that's the actual lithography machines, they accounted for $5.6 billion.
Okay.
That remaining $2 billion came from what they call installed base management, or IBM.
Right, IBM. Yeah. That's the service side.
Exactly. For the listener, this is the really lucrative service parts and upgrades business. It provides a very stabilizing, high-margin revenue stream, almost regardless of the volatility in, new tool sales cycles.
Very important buffer. Now, within those system sales, EUV extreme ultraviolet systems brought in $2.1 billion. And that total included something pretty major, didn't it? A landmark technical achievement.
It did. The shipment of their very first high-NA system.
Finally.
Yeah, that first high-NA shipment is a massive technological milestone. Now, its revenue contribution right now is, let's be honest, nominal compared to the total.
Sure.
But it signifies that the technology has officially moved from the R&D lab floor into the customer's actual fab. That's huge.
And the customer split for systems. Still logic heavy.
Still logic heavy, yeah. System sales were 65% logic, so your CPUs, GPUs, like specialized AI chips, and 35% memory, DRAM, and NAND. Logic definitely continues to drive the highest value part of the business.
And financially, they kept things tidy. Gross margin solid at 51.6%, right in the expected range. That led to, what, $2.1 billion net income?
$2.1 billion net income, yeah. And an EPS of 5.49. So like you said, a very controlled, highly profitable quarter overall.
Strong execution. But if you want to gauge future confidence, you always look at the order book, right?
Always.
How did that look?
Pretty good. Q3 net system bookings totaled 5.4 billion.
5.4 billion. Okay.
That's a robust figure. It really demonstrates that demand hasn't significantly slowed down, despite, any geopolitical noise or macroeconomic friction you might hear about.
That booking strength, that's the forward signal we need to watch. And what's particularly interesting, I thought, about that 5.4 billion in bookings is the breakdown.
Exactly. The split was 3.6 billion for EUV systems and 1.8 billion for non-EUV systems. So that massive EUV component points directly to this advanced node expansion we need to talk more about.
Definitely.
But the real insight, I think, came from the end market split of those orders. They were almost perfectly balanced. 53% logic, 47% memory.
That near 50-50 split, that is crucial, isn't it? Because traditionally, logic has just dominated new tool orders. So what does that massive influx of memory bookings, 1.8 billion for EUV for memory, tell you about this AI momentum?
It tells us the AI tailwind isn't just driving the complexity of the processors, the logic side, it's also driving the need for that high bandwidth, high density memory required to actually feed those processors.
HBM and things like that.
Exactly. High bandwidth memory, next gen DRAM. When memory customers commit to nearly 2 billion worth of EUV tools in a single quarter, they are confirming multi-year strategic roadmaps that absolutely require advanced lithography. This is a huge commitment to advanced node transitions by the memory sector, which, let's remember, often operates on much tighter margins than logic.
So given these massive bookings, and we know the backlog is reportedly huge, how do we square that strength with the revenue projections for 2026? Some analysts still seem a bit cautious there.
Right, and this is where management provided some really essential nuance. The sheer size of the backlog, it can be a bit misleading if you don't account for the nature and the timing of the tools within it.
Right.
We know they said a pretty healthy number of those existing orders are actually scheduled for revenue recognition beyond 2026.
Okay, so longer term.
Longer term. And this includes a strong contingent of those new high-NA tools. They're extraordinarily expensive, yes, but they won't transition from the installation and testing phase to full revenue recognition until much later, probably 2028 or 2029 for any kind of high volume.
So you can't just take the total backlog number and divide by next year's expected revenue. It doesn't work like that because the mix is shifting towards these incredibly complex, long installation cycle tools.
Precisely. It's not simple math. The complexity of high NA means they sit on the customer site longer before they meet all the contractual milestones for revenue recognition.
Right.
This also extends the working capital cycle, which, we should probably circle back to later.
Good point.
And the math gets even more complicated by the sheer quantity of standard, low NA EUV and deep UV tools needed for all the mid-2020s node transitions happening concurrently. Those revenue recognition cycles differ wildly, too.
Okay, makes sense. Looking ahead just immediately then, Q4 2025. They're expecting a very strong finish to the year, aren't they?
They really are, projecting Q4 net sales strongly between 9.2 billion and 9.8 billion.
That's a massive quarter.
It's huge. And it confirms their full year 2025 expectation. Total net sales still expected around 32.5 billion, with that full year gross margin near 52%. So yeah, they're executing right on their yearly target.
Okay, let's zoom in on the expected Q4 gross margin range, though. 51% to 53%. That feels like a fairly wide range for ASML. They're usually so precise.
Sure.
What are the sort of puts and takes affecting that margin?
Yeah, it's a really interesting mix problem they've got in Q4. On the positive side, the sheer volume of sales is highly efficient, right? When you run your factories flat out, you absorb your fixed overhead much more effectively. That's a natural margin tailwind.
More units, better absorption, standard stuff.
Standard stuff. But then you have the strategic drag from the new technology coming online.
An INA effect.
Precisely. They're shipping 2 high-NA systems in Q4, and those systems right now are a significant negative mix factor for margin.
Why exactly? Just cost?
It's the whole package. A high-NA tool costs hundreds of millions of euros, sure, but it also requires immense R&D amortization to be accounted for, dedicated cleanroom space for assembly, which is expensive, highly specialized field support engineers. At this incredibly low volume, the gross margin on those specific tools is barely positive.
Barely positive? Wow.
Yeah. Which means they significantly dilute the overall corporate average margin.
So the company is essentially accepting a temporary margin hit now as an investment in qualifying and installing the very technology that's supposed to define their profitability out towards 2030.
That is exactly the commitment they're making. Now, this dilutive effect, it is partially offset by, the excellent performance of that installed base business, the service and upgrades we talk about.
Right, that's high margin.
Very high margin, typically well above the corporate average. And also just strong execution on the regular low NA EUV tools. So it's this carefully managed dance, really, between maximizing current profitability and paving the runway for the future.
Okay, let's pivot now to that strategic narrative, which really seemed to dominate the management commentary this quarter. One of the clearest takeaways for me was this dramatic reduction in market uncertainty compared to what they were reporting, say, 6 or 9 months ago. Where did that sudden confidence boost come from?
It comes overwhelmingly, almost entirely, from AI.
No surprise there.
No surprise, but the scale is key. The sustained massive capital expenditure commitments being announced across the entire tech ecosystem for AI infrastructure. They're now translating directly into validated, concrete demand for advanced chips.
So it's not just talk anymore.
It's not just talk. The uncertainty ASML previously reported, that really stemmed more from general macroeconomic softness, right? AI is simply overwhelming that softness now. It's creating a new, verifiable growth floor for the high-end semiconductor market.
And what's fascinating here is something you touched on earlier, is that this positive AI momentum is now broadening. It involves more customers in both logic and DRAM. Why is that specific detail, the breadth of customers, so critical for ASML's longer-term stability?
Oh, it addresses a fundamental risk. Think about it.
Yeah.
If AI demand were driven only by, say, one or two hyperscale customers, maybe one giant foundry building chips for just two major cloud providers.
Right, concentration risk.
Huge concentration risk. ASML's fate would be too tied to the fortunes and spending cycles of just a couple of players. But this broadening, it indicates that a diverse group integrated device manufacturers, IDMs, specialized foundries, even some vertical players, maybe they're all entering the advanced node space to capitalize on AI opportunities.
Okay.
This diversification makes their overall market demand far more resilient, much less susceptible to the cyclical spending whims of just one single entity. It fundamentally de-risks their outlook for, say, 2027 and 2028.
And this broadening demand, it seems to be feeding into a deepening of what they call lithography intensity. Customers are adopting more EUV layers in both logic and DRAM. Is this just, Moore's law grinding forward inevitably, or is there something more strategic happening here?
It feels highly strategic. It's not just about making features smaller anymore. It's about managing complexity. At the 3 nanometer and especially the 2 nanometer nodes, trying to achieve the required resolution using the older deep UV light, which has a larger wavelength, remember, it requires incredibly complex processes, multi-patterning.
Right, exposing the same layer multiple times.
Sometimes 4, even 6 separate exposure steps just for a single critical layer. It's costly, it's slow, and it's a killer for manufacturing yield.
So customers are finding that migrating those really complex deep UV multi-patterning layers to just a single exposure using an EUV layer, it simplifies the whole process flow, even if the EUV tool itself is way more expensive up front.
Exactly that. It becomes an economic decision based on total cost of ownership, driven by yield and throughput. You're essentially replacing process complexity with tool capability.
Right.
And this trend maintains extremely high lithography intensity at these advanced nodes. The complexity doesn't disappear. It just gets shifted from that multi-step DUV process onto the single, incredibly high-tech EUV tool.
Now, let's tackle a specific kind of complex architectural question in memory. There's this shift happening from the traditional 6F squared or 6F odd architecture to the potentially more dense 4F squared, 4F1 in DRAM. It sounds like an effort to cram more memory cells into the same area, but there was this concern floating around that this density improvement might somehow reduce the need for EUV layers.
Yeah, that was a reasonable theoretical concern. Because, on paper, a denser structure might require fewer distinct layers overall. However, based on ASML management's deep discussions with their major memory customers, the reality seems to be the exact opposite, especially as the roadmap progresses further down the line.
How does that work? How does making the memory cell physically smaller end up increasing the demand for the most advanced lithography?
It's about how they achieve that density with 4FFOT. You're not simplifying the structure. You're making the lateral dimensions impossibly small and creating really complex vertical 3D structures instead.
Ah, the vertical aspect.
Right. To manufacture a stable, high-yield capacitor or contact at those incredibly tight dimensions, we're talking structures maybe the height of your fingernail, but impossibly narrow, you need extreme precision. Deep UV multi-patterning just starts to break down at that scale. The sheer complexity of the 4F5 structure, particularly as DRAM makers push towards the 1 alpha and 1 beta nodes, actually mandates the use of more EUV layers to properly define things, like the word lines and bit lines, with sufficient accuracy.
So it becomes a technical necessity. The structure itself is so complex that the EUV layer count is actually expected to continue growing as this 4FOM roadmap progresses.
Precisely. And it's important to note, this architectural shift isn't just a win for EUV, it's arguably a win for all advanced lithography. The move to 4FIO requires more masks overall, the stencils used during the exposure process. So even the advanced deep UV tools benefit from the increased complexity of the mask requirements generated by this relentless drive for density.
Okay, so pulling this all together, this shift fundamentally alters the expectation for 2026, doesn't it? Management now sounds quite confident that overall 2026 total net sales are not expected to be below the 2025 level of around $32.5 billion.
That stability message was critical, yes. And it's a direct result of this accelerating shift to advanced nodes. The key here is the pivot in the product mix they foresee. The EUV business, driven by this burgeoning demand in advanced DRAM and leading-edge logic, all turbocharged by AI, that part of the business is expected to be up significantly in 2026.
And this massive EUV upswing is crucial because it's needed to offset the expected and also significant downswing in the deep UV business, which is driven primarily by those dynamics in China we need to talk about next.
Exactly, that's the trade-off. The end market shift is accelerating the movement of ASML's product mix towards the most intensive, highest value advanced lithography systems. Structurally, this is incredibly positive. It reinforces that huge long-term financial opportunity they outlined in their 2030 roadmap. The core of their business is strategically pivoting to higher value, even if the top line looks flat for a year.
Okay, let's confront that impending drop in deep UV sales head on then. Management expects China total net sales in 2026 to decline significantly. That was the word they used. Significantly compared to the, frankly, unprecedented levels we saw in 2024 and 2025. Now, that sounds worrying on the surface, but management is trying to frame it as a necessary normalization, right?
It absolutely needs to be seen as normalization, not some kind of collapse. Management was very, very clear that the high sales volumes pumped into China over the last 2 years were, and I quote loosely, in no way normal. We need to step back and understand why that spike happened in the first place.
It was really a classic catch-up cycle playing out, wasn't it?
Precisely. For various reasons, market restrictions, internal capacity build-out cycles, ASML had effectively been underserving the China market for several years prior. Once the global supply chain capacity finally stabilized a bit, they started aggressively eating into that huge pent-up backlog specific to China. That surge we saw really represented years of deferred demand being satisfied all at once.
Okay, so they're anticipating sales will now return to what they termed a more reasonable business level. What does that historical sort of reasonable baseline level look like for China in their mix?
Historically, management has stated that China represented around 20% of their overall backlog, maybe slightly more sometimes. The view now is that the sales volume should return to a level that's more commensurate with that long-term percentage, plus, the organic growth of the specific market segments within China itself.
Right.
And we need to remember, the Chinese market primarily focuses on mainstream logic, mature nodes, memory to some extent, but mostly stuff requiring older deep UV systems, both 200 millimeters and 300 millimeter. The kind of boom levels seen in 24 and 25 were just fundamentally unsustainable if you look at a normalized assessment of that specific segment's long-term growth potential.
So this normalization, it's effectively a trade-off playing out in the numbers. We lose some of that short-term, high-volume deep UV business from China, but we gain more confidence in the strategic, higher-value, high-NA and EUV path driven by demand outside of China.
That is the pivotal financial and strategic trade-off shaping up for 2026. While the deep UV sales will decline substantially due to that China normalization, the overall 2026 outlook is protected, even stable, precisely because the increase in the EUV business driven by global logic and that advanced DRAM demand is expected to fully offset the deep UV drop. The quality of the revenue mix is actually increasing, even if the top line appears flat year over year.
This kind of major transition, though, it really highlights the enormous need for flexibility in their operations, doesn't it? I mean, ASML deals with incredibly long lead times for key components. Some require building specialized factories years in advance. How is management ensuring they can actually handle what could be a pretty lumpy global demand profile while managing this internal pivot at the same time.
Well, their flexibility really stems from strategic capital expenditures they made years ago, anticipating this kind of thing. They've invested heavily in building the shells for factories, securing clean room capacity ahead of time, getting commitments for long-lead optical components way out into the future.
So it's like buffer inventory, but of infrastructure, not finished machines.
Exactly. It's infrastructure and capacity buffering. So if a major customer suddenly accelerates a node transition in, say, 2027, ASML can theoretically activate that pre-built capacity much faster than if they were starting from scratch.
Ah, okay.
The key really becomes shortening the final cycle time, the time it takes to deliver a machine once a firm order is placed and locked in. And that relies heavily on continuous, timely communication between ASML and its global customers. They need a good heads up, on required tool delivery so they can manage that final assembly and integration process efficiently. The strategic supply chain flexibility is absolutely critical. It's what should prevent ASML from becoming the bottleneck in the highly sensitive global chip market over the next few years.
Okay, let's switch our focus entirely now to the future of holography itself, high-NA EUV. There's been significant chatter recently about maturity milestones. What was the most important metric or data point they hit this past quarter?
The milestone that really stood out was the cumulative data set accumulation. They announced they've now run cumulatively over 300,000 wafers on the high-NA systems currently installed at customer sites.
300,000 wafers, that sounds like a lot.
It is a lot. That number represents hundreds of thousands of individual test cases, exposures, measurements. It's a massive amount of real-world performance data being fed back continuously to the engineering teams, validating how the tool actually performs in a fab environment.
And how does that compare to the introduction of the first generation of EUV, the low NA systems, about a decade ago? Because that rollout, if I remember correctly, was notoriously difficult and painfully slow.
Yeah, the comparison is strikingly positive, actually. Management stated that customer data shows the high-NA platform is well ahead, their words, of where low-NA EUV was at the exact same stage in its introduction cycle.
Okay, well ahead. Why? What's the key difference?
And here's the single most crucial differentiator, the game changer, really. The historic Achilles heel of low-NA EUV development was the source, that incredibly complex laser-produced plasma generator that creates the EUV light itself. That source took years and years to stabilize and achieve industrial-level availability and power.
Right, I remember the source issues dragged on forever. So the high NA system, it uses that already matured source.
Exactly. The high-NA system uses the exact same fully matured, high-power, low-NA source that's been running reliably in fabs for years now. This means they are not fighting that fundamental physics and engineering battle of light generation simultaneously with the battle of building the completely new optical platform for high-NA.
That makes a huge difference.
Massive. They are only focusing engineering effort on the platform itself, the new optics, the wafer stage, the alignment systems, which is still a monumental challenge, don't get me wrong, but it's a much more contained engineering problem than fighting source physics and platform physics at the same time.
So does this mean the overall technology readiness is accelerating faster than maybe people expected?
It certainly looks that way. Management now expects final specification validation, which basically means confirming the overall system capability, hitting the target resolution, overlay, and defectivity specs. They expect that to happen within this current year, 2025.
Within 2025.
Yeah. This rapid maturation suggests that the platform availability, the tools uptime, should be in very good shape, again their words, within the next 12 to 18 months. That timeframe sets the stage nicely for customer qualification runs and then initial insertion into pilot lines.
So when does this start turning into meaningful revenue for ASML and actual high-volume manufacturing insertion at the customer end?
The next wave of significant high-NA orders is expected towards the second half of 2026.
H226, okay.
And that timeline seems carefully calibrated. Customers, understandably, want to see that final qualification data demonstrating the tool's maturity and yield performance in a near-production environment before they commit to large-scale multi-system purchases. Shipments are ramping now, slowly for those qualification purposes, but we anticipate actual high-volume manufacturing insertion where these tools truly start defining a significant portion of production output, probably more in the 2028-2029 timeframe.
Let's just quickly revisit the margin profile. We talked earlier about how high NA is currently dilutive to the corporate average. Is the system itself actually profitable on a unit level yet?
Okay, on a strict unit level, Just the sale of the physical tool itself, management says the gross margin is currently very low positive.
Very low positive. So barely making money on the hardware sale itself.
Pretty much. But then you have to factor in those massive accumulated fixed costs. We're talking the multi-billion euro R&D investment spread over many years, the custom factory floor space needed just to assemble these behemoths, the army of specialized technical support staff required. All those high fixed costs are currently being absorbed by just a tiny handful of units being shipped.
Which seems to imply that volume, pure and simple, is the only viable path to achieving meaningful profitability for High-NA.
It is absolutely the only significant driver. That fixed cost base is essentially locked in now. The only way to drive the margin contribution up towards the corporate average is through maximizing production throughput and delivering more tools. However, because of the sheer complexity and the limited nature of the absolute cutting-edge market these serve, management forecasts that even by 2030, High-NA will likely remain slightly margin dilutive compared to the overall corporate average.
Interesting. So it's a necessary strategic capability, absolutely essential for the future, but maybe not the primary margin driver, even long term.
That seems to be the realistic assessment, yes.
Okay, pivoting slightly. Moving from shrinking things horizontally on the wafer to stacking them vertically. ASML also made a pretty significant announcement regarding advanced packaging, or 3D integration as it's sometimes called. They announced their first dedicated 3D integration product, the XT.260.
Yes, this is a really shrewd strategic move, I think. ASML is formally acknowledging that while traditional lithography continues to scale, the slowing of that scaling rate means Moore's law is becoming increasingly reliant on innovation in advanced packaging and vertical stacking techniques.
Right, chiplets and stacking.
Exactly. The ability to stack multiple chips efficiently, like logic dies, memory dies, specialized I/O dies, is absolutely essential for the next generation of computing performance, especially for complex AI accelerators.
So what exactly is this XT.260, and why is an eyeline scanner, which uses much older, longer wavelengths light, suddenly relevant again for advanced packaging? That seems counterintuitive.
It does a bit, doesn't it?
Yeah.
The XT.260 is indeed an eyeline scanner, meaning it uses light at the 365 nanometer wavelength. You're right, that's older technology compared to DUV or EUV. But for many advanced patching steps, particularly things like creating through silicon via TSVs or the redistribution layers, RDLs that connect chiplets, you don't actually need the sub-10 nanometer resolution of EUV.
Okay, so resolution isn't the main challenge there.
Not the primary challenge. What you do need is extreme precision and alignment between the different layers being stacked, and also the ability to process wafers that might be thicker or more uneven, warped even, because of the multiple layers already built up.
Oh, so alignment and handling those non-perfect wafers are key.
And throughput, I guess.
Exactly. Alignment and throughput are king in packaging, and the XT.260 apparently uses a unique optical design to offer up to 4 times the productivity compared to existing solutions on the market for these specific packaging steps.
4 times the productivity? That's huge.
It's a massive jump, and high throughput translates directly into lower manufacturing costs for the customer, which is absolutely critical in the highly cost-sensitive packaging ecosystem. They shipped the first system this quarter, and management sounded pretty bullish, expecting to ship to quite a few more customers soon because of the strong interest and that high business benefit this high-productivity eyeline tool provides relative to older options.
Yeah.
Okay, moving beyond the hardware for a moment. For decades, ASML has really been defined by its incredible complex hardware. But this quarter, they made a massive statement, I think, about the future importance of software by announcing this strategic partnership and significant investment in Mistral AI. This feels like it signals a shift in their competitive moat, doesn't it?
It absolutely does. It's a major signal. And what's really fascinating here is how they articulated the role of software going forward. It's clearly moving beyond just, the software needed to operate the hardware itself. It's about embedding generative AI capabilities across ASML's entire holistic portfolio, everything from the chip design interfaces they offer right through to the final tool calibration and ongoing process control in the fab.
And what's the explicit goal they stated for embedding this generative AI capability across the board?
The goals seem highly focused on system economics and performance for the customer. They want to use AI to increase overall system performance, boost productivity, meaning more wafers per hour per tool, and significantly improve customer process yield.
Yield is always critical.
Always. I mean, imagine if an AI system integrated into the tool can predict a potential maintenance issue before it actually causes downtime, or if it can automatically optimize the tool's lithography parameters in real time, mid-run, to account for tiny variations. That translates directly into higher uptime and better yield for the chipmaker.
Makes sense.
And internally, they also hope AI will lead to faster innovation cycles for their own tool development, improve their time to market, and ultimately lower their own development costs.
The financial commitment here was certainly not trivial. ASML led the Series C funding round with a colossal $1.3 billion investment in Mistral AI.
That number speaks volumes, doesn't it? 1.3 billion.
Yeah.
It feels like a very offensive move to ensure ASML stays way ahead of the curve in leveraging AI for semiconductor manufacturing. This investment resulted in them acquiring an 11% share in Mistral AI, and maybe more importantly, strategically, a seat on Mistral AI's strategic committee.
So they have direct input.
Direct input. This isn't just a passive financial investment. It cements their connection deep within the rapidly evolving AI ecosystem. It ensures they're not just suppliers to the AI chip market, but they're actively using cutting-edge AI to optimize the very creation process of those chips.
Does this feel more like a defensive strategy, protecting their existing hardware moat? Or is it more offensive, trying to expand into new, potential revenue streams maybe?
I think it's probably a bit of both, but leaning more towards offensive in nature. On one hand, yes, it creates a deeper, more integrated competitive moat that competitors, especially any who might lag in sophisticated software development, will find very difficult to cross.
Yeah.
By optimizing yield and process control through software, they make their hardware tools even more indispensably integrated into the customer's complex manufacturing flow.
Locking them in deeper.
Exactly. But it also clearly opens up the potential down the line for new high-margin software licenses and service contracts related to these AI capabilities. It could move their revenue stream further up the overall value chain beyond just selling the big machines.
Okay, connecting this all back to the big picture then, did management reaffirm their entire long-term vision, the one they laid out at the Capital Market Day last year, despite all this volatility we've seen, particularly in the deep UV market recently?
Yes, they were very clear on that. The 2030 roadmap remains fully intact. And arguably, it's even reinforced by the strategic pivot towards advanced nodes and software integration we've been discussing. The continued accelerating shift towards advanced logic and DRAM requiring intensive EUV usage provides the structural underpinning for that long-term view. They still expect the 2030 revenue opportunity to land somewhere between $44 billion and $60 billion.
And crucially, the high margins associated with that revenue are still projected to hold.
Absolutely. They expect a corresponding gross margin in the range of 56% to 60% by 2030. They see multiple levers to pull to achieve that. The increasing productivity and profitability of their mature low-NA EUV systems, the successful strategic insertion and ramp of high-NA eventually, and now this added potential for yield optimization and service revenue driven by the Mistral AI partnership. All these factors combined are expected to help them reach the high end of those long-term revenue and margin targets.
Okay, let's try and bring this massive analysis back together then. It feels like we've seen a really powerful strategic acceleration confirmed this quarter. We're clearly moving from a period of just general market recovery into one that's fundamentally defined by the AI imperative.
Yeah, the key takeaways feel crystal clear now. First, AI is undeniably accelerating the demand for the most advanced nodes, both in logic and significantly now in memory. Second, this confirms a likely permanent increase in EUV layer count requirements, even in architecturally complex areas like that 4F² DRAM. Third, we're seeing the strategic management and normalization of the deep UV sales cycle, particularly in China, which looks set to be entirely offset by the EUV upswing globally in 2026.
And fourth, the future preparation seems well underway. High-NA is maturing faster than its predecessor, largely thanks to that shared source technology, which is a huge advantage. And this massive investment in software via Mistral AI confirms ASML's drive for superior yield and productivity gains across the entire ecosystem, moving beyond just the hardware itself.
Absolutely. Though before we close, maybe we should quickly address that recurring operational question, working capital. Inventory and working capital levels have been rising, which sometimes seems like a paradox when orders are strong. Strong orders usually mean strong cash flow eventually, so why the rise in inventory?
Right. Why is that happening? Is it a sign of some kind of inefficiency creeping in?
It seems directly tied to the high-NA rollout, and it's probably less about inefficiency and more about inherent complexity. First, just the physical size and the sheer complexity of these high-NA machines mean the installation cycle time at the customer site is really long right now. That tool sits there effectively as inventory on ASML's books, incurring costs until it's fully accepted by the customer and the revenue can finally be recognized. That ties up capital.
Okay, the long install time. What else?
Second, while the orders are strong, ASML receives significant down payments from customers when these huge orders are placed. Now, accounting-wise, these large down payments actually show up as a negative drag on the operating cash position until the final delivery and revenue recognition occur much later.
Ah, okay. So the cash comes in early, but messes with the working capital calculation until the end.
Precisely. So, the single biggest action ASML can take to improve its working capital intensity really ties right back to the product roadmap, reducing the cycle time for installing and qualifying those high-NA systems.
So it all comes back to high NA again. Achieving higher volumes and just shaving time off that installation and qualification period for high NA, probably out in the 2028-2029 timeframe, that will be the primary lever for improving cash conversion and those working capital metrics.
Exactly. Everything seems to feed back into the volume, efficiency, and maturity of that next generation tool.
Which brings us nicely to our final thought for you, the listener, as you kind of look towards the next 12 months or so. The fundamental economics of advanced computing feel like they have shifted. This AI value proposition is justifying the move to more expensive advanced nodes much faster, perhaps, than any prior technology transition we've seen.
Yeah, just think about the speed of the 2 nanometer node ramp we're hearing about. It feels historically unprecedented. This acceleration, combined now with the fact that AI demand is broadening the customer base beyond just a handful of giants, creates really intense competitive pressure across the board.
More players needing the best tech.
Exactly. And this competition forces faster cycles of investment and adoption. It means the speed at which customers actually move through these advanced nodes and therefore place orders for the next generation of EUV and high-NA tools could potentially accelerate even quicker than perhaps even ASML's management currently forecasts. That heightened speed, that potential for even faster acceleration, that's the dynamic we'll definitely be tracking closely.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.